But shifting focus and welcoming on board Srinivas Rao Ravuri. He's the ED and Chief Investment Officer, International Business at PGIM India Asset Management. Srinivas, thank you so much for making time and speaking with us. Let's start with the market itself. Those record high levels don't seem to be coming in easily at all. Over the last 5 days, we have been just toying around that mark. But if and when we do hit that, what next lies ahead for the Indian markets? Do you see more legs to the rally?
Yeah, thanks for having me here. Actually, if you look back what has happened in the last 6 months, I think we should be very happy with where we are in the market. I think 6 months back it was a kind of a gloomy scenario where we've been hit by inflation, higher interest rates, and we were seeing a clear slowdown in corporate earnings also, both on the top line as well as pressure on the margins. From there, after hitting lows in March, markets have seen a very, very strong rebound. Which is justified given the fact that corporates also have done very well. The first quarter results that we've seen, numbers have been much better than what the street was expecting, and economy also seems to be doing pretty well. I think this applies to not just India, even globally also. I think versus the fears of a recession in Europe, US, what we are witnessing is a fairly strong resilience across the world. The same is applying here, and also, I think the other factor that we have in India is China has not done so well. So for global investors looking at investing in emerging markets, it seems to be there is an inverse correlation. So people who want to take out money from China, some of that money is coming to India, and that is what led to a very, very strong inflows from FIIs, and that is also fueling this rally that we are seeing in the markets. So it's only a matter of time before we will hit all-time high and continue from there, given the strong fundamentals. However, I think one should be cautious. I'm clearly seeing there is a bit of a complacency that is set in the market. We're already seeing large blocks happening by the EP, which is also indicator that some of them want to benefit from this rally and book profits. So there are signs to be careful, but on a 2-3 year perspective, I think the economy and markets both seems to be extremely positive.
Very interesting that you say that, Srinivas. Please elaborate. Why do you think, besides block deals, of course, which have really been where all the action is, why do you think this complacency is setting in the market? And do you not believe that we are still fairly valued, or do you think that the market as a whole is getting a little toppish in terms of valuations?
I would say it is getting a little toppish. We are, if you look at 1 year forward earnings, we are slightly above 5-10 year average. So to that extent, valuations are definitely not cheap. And the second aspect is, if you see even last 25 days, I think after 25 days, 24 days now, small cap index is up. This is another typical sign where small cap, when in a buoyant environment, small caps tend to do better than the mid and large cap. And if you see number of stocks hitting 52-week highs, these are all classic signs of buoyancy. And when markets do well for a few weeks, people tend to assume that it will continue for next foreseeable future. And that is where I'm saying that there is a complacency, assuming that there is only one way. But we've seen enough in the markets that this can't last. Block deals, and I'm saying that we are also seeing IPO market getting revived. It's a positive thing, but again, when markets are good, people tend to price issues very pricey, and which is not a good sign for markets.
Yeah, we all remember that class of 2021 wherein there was that entire euphoria around the IPOs. Not sure if there's going to be another class of 2023. But Srini, in that sense, where do you recommend to book profits then? Which is the space which looks very overcrowded, overheated, overbought?
I would say it's not across sectors, but selectively I'm seeing excessive valuations. I'm saying markets are trading at 19 times 1 year forward. This is an average, but companies that have a sustainable growth prospects can trade at, let's say, 25-30 price to earnings. But if you're seeing a few companies trading at almost 50 times price to earnings, and assuming that what they've delivered in the last 2 years will continue for next 2-3 years, and trying to price that in right now itself is where I think there are challenges, and we are clearly seeing, like for example, consumer staples has clearly seen growth slowing down, both rural and even otherwise. Volume growth has been lower single digit. Still, I would say valuations are fairly expensive. So across sectors, I would say there are wherever you see valuations in this very simple metric of price to earning more than 45-50 is when one need to be cautious.
That's quite interesting that you say that. But Srinivas, do you believe that there are still those value zones in the market, those long haul or long term conviction spaces? I mean, going by the consensus opinion, it seems that defense, infrastructure, manufacturing seems to be that one theme.
I would tend to agree on the manufacturing front for sure. Infra, I think a few pockets, whereas defense. Though I am also extremely bullish on the medium-term prospects, given the fact that A, country will spend more on defense, and B, within that, Indian companies will actually benefit more versus in the past where India used to import anywhere from 60 to 70% of its capital requirements, and government push would lead to this shifting towards the Indian manufacturers, and as a result, companies will benefit. But in markets, what is important is what are you paying for? I would say, given the rally that we've seen in defense stocks in the last 2 months, I think quite a bit of it is already priced in. So there are a few secular trends like manufacturing. I think undoubtedly manufacturing has revived and led by PL and other schemes. We will see manufacturing doing extremely well. So is the case with, I would say, in infra. But we need to, as a fund manager, our job is not just to look for companies and sectors that are likely to do well, but also make sure that we are not overpaying, and that is where I have an issue right now.
So defense seems to have priced in the positives already, but do you think the negatives are priced in the IT basket now? And would you incrementally look at buying or nibbling into some of the names?
Yeah, I think IT is at an interesting space right now. These companies are great. They generate a very high cash flow, ROE, governance levels are fantastic. But I don't think all the negatives are priced in the sense, if you see the net hiring by IT companies in the last 2-3 quarters, it is almost negative, which in turn means what? They are also turned cautious, and people are input for IT companies. And this is a clear sign that they also see a slowdown. So overall, we still see concerns in the IT sector on demand outlook. Within that, there are pockets where we may see reasonable growth, but I think companies that are dependent more on, let's say, BFSI, banking, financials, will definitely see more slowdown. So to that extent, I think one can increase exposure to IT, but still one should be underweight in the sector for a few more months, is what I believe.
Okay, so that's it. That's the outlook as far as the IT sector is concerned. But Srinivas, you still hold a lot of those top banking names, right? ICICI Bank, HDFC Bank, they continue to be your top holdings. Are you not looking at getting into the mid-tier banking names or even PSU banking names?
So we have selective exposure to both the mid-tier and PSU, but I would say both are tactical calls. Mid-size financial names as well as the the names that you have taken, these are large liquid core holdings. Overall, I remain positive on the financials, given the fact that I think they have demonstrated a solid earnings growth, and that is likely to continue. We are seeing a clear revival in credit growth. The costs are under control. The credit costs are definitely under control. And valuations are not expensive or not unreasonable. So there you have the comfort of both visibility on growth and also on valuations, and that's what makes us to be overweight positive on financial space even today.
Right, Srinivas, we're going to be chatting with Vibha Padalkar from IDFC shortly. Just wanted to understand, what is your own sense, especially in the backdrop of, the entire sector now having to work with lower tax benefits. What are you making of whether this is a good investment bet or not? Because they've definitely covered a lot of ground since those budget time lows.
So without getting into stock specific, see, I think what government has been doing, I think, which is a credible thing in terms of making sure that they take away the arbitrage opportunity that was available for few segments. They want to have a transparent system, and then that's what we are moving. So I think there are clear opportunities even today across the space. So I remain selectively positive.
Right. Okay, that's the take coming in on the insurance sector. Just going to revisit what the market as well has settled in at. While it was sure a flat start, it hasn't gone anywhere really from there. We continue to be quiet. In fact, actually, no, I stand corrected. We've fallen about almost 100 points, at least on the Nifty futures. 105 points lower now. 18,724 is where it's currently at. Adani Enterprises down about 3.25%. Mothers and Soon M&M Finance, Adani Ports, HPCL. They're all the ones which are the weak links in the market right now. But Srinivas, the other space which a lot of people are now sort of turning towards, at least in the last 1 year, and is that one contra bet is power ancillaries. Wanted to understand whether you see benefit really in this sector from an investment perspective.
Our demand per se, yes, our per capita consumption is very low. So to that extent, we will continue to see demand going at, let's say, 5-7%, both for residential as well as the industrial usage. So it's a utilities, companies that are supplying power to consumers are in a, I would say, reasonable spot, especially given the fact that the valuations, even including not just the price to earnings, price to book, but even the dividend is fairly decent at these levels. However, these companies are facing the issue on the green front. In India, we even today, majority of the power is coming from coal, and globally, I think most investors have turned extremely negative on coal-based power projects and business. And to that extent, they don't want to buy if they want to remain ESG compliant. So that's the challenge from the investors' point of view. But I don't think in India, given our situation, we will move away from coal-based power plants anytime in the near future. However, it is interesting to note last 2-3 years also 60 to 70% of capacity additions were on the renewable space. So we have to play, I would say, tactfully, in the sense companies that are increasing their portfolio of renewable assets is where I see clear alpha coming in. However, one has to remember, as a financial investors, the renewable space will take longer to generate IRRs that we want. So overall, I would say power is an interesting space, and stocks are available at a very compelling valuations. But they are unlikely to show a re-rating. Ideally, we want to buy companies that are trading cheap or reasonable valuations with the expectations that they will see a re-rating. Whereas in case of power, I would say returns will be in line with earnings growth. I don't expect any re-rating happening there.
Where will the re-rating happen then, Srinivas? You briefly touched upon IT, but you're also cautious on the market, and you do feel that it's getting to that complacency stage. Any pockets where you still find value?
Well, there are pockets. So I think the India story is all about actually entrepreneurs. I think one is looking at only the top 20-30 stocks. But if you see right now, almost 3,000 stocks are actively traded. That number is very, very high. So over the last 10, 15, 20 years, I think the India story is all about entrepreneurship. We've seen number of promoters, from zero, building $1 billion, $2 billion kind of businesses. So companies that are delivering significantly higher growth than the broader markets or GDP, are available, and I continue to see opportunities. Let's say whether it is the manufacturing, capital goods, even in pharma, I would see there are enough opportunities even today at these valuations.
Okay, Srinivas, on that note, we'll let you go. Appreciate you joining us on the show today. But shifting focus and welcoming on board